In this video, we'll look at how to trade crypto options. I'm going to go through actually how to place trades on a platform like this, which is a crypto options platform like Bybit. Binance also do crypto options as well. And then we'll go through some of the basics right here of what the options are. And towards the end, some very common options strategies as well that people can use to actually, trade those options and trade different prices or volatility in the market. So I'll leave timestamps for everything below. We'll come to an options trading screen first then, and yeah, this looks like a total mess, but it's actually fairly simple. I'm going to be using BTC options right here. It's the most liquid market, and really just like any other market, you have buyers and sellers of something, right? So there's two different type of options you can have. There's a call option, which is the option to buy something, and then you have a market for that. So you can either buy the option or sell the option. And then on the right-hand side, you have puts, which are the right or the option to sell. And you can either buy those or sell those as well. So I'll go through what that is right here. If you want to link to Bybit as well, look at the description. There's a deposit bonus right there. They give other bonuses as well. So if you want to trade on Bybit, check that link in the description. Binance is down there as well. They give a deposit bonus. So check those out via the links. Really though, if you are a beginner, we're going to very quickly go through what options are. So an option obviously is the option but not obligation to do something in the future, right? So that is what an option is. And it can be an option for anything. We're going to be talking about crypto and specifically Bitcoin or Ethereum options, right? So you have the option, but not obligation to do something in the future. That is if you buy the option, right? So if you buy an option, you are getting optionality to do something in the future. Now, if you sell someone else the option to do something, then you actually are obliged to do the things that they want to do, right? So if you're giving someone else the option to do something, they may or may not exercise the option, but if they do, you are obliged to obviously carry out because you gave them that option, right? So you can either buy the option or give someone the option. There's an expiry date always with options. They must have an expiry date, right? They can't go forever. So there's a definite expiry date that we trade, and there's a strike price, which is the strike that the option trades at, right? So if we're looking at Bitcoin and you're saying, well, I want to buy Bitcoin in the future at a certain price and I want to buy that option, well, obviously you need a strike price for the option, right? And so that's what we look at right here, and that is the thing in the middle, right? So we're looking at strike prices, and every option you can have a different strike price. On Bybit, they are in almost $500 increments, right? Premiums, these are the things that you pay or receive. So if you buy the option to do something, right, you're buying the option, and so that's probably valuable, right? If you're buying a call and so you're saying, hey, I want to buy Bitcoin from you in the future, then someone probably needs to get paid for taking that risk and giving you that option, right? So the premium is something that is exchanged from the buyer of the option to the seller of the option. Now that's really good because you can either pay that, which is obviously a cost to you, but if you're giving someone the option to do something, you can actually receive that premium. So that's like income for you, and that's what option strategies are trying to do as well. So what is a call option? A call option is the option to buy at a given strike price and exercise date in the future, right? These are calls, as you can see here on the left-hand side, right? So people are buying and selling the right to buy in the future. A put option is the right to sell at a given price in the future. Now you can buy and sell that option, right? Depending on what you want to do. Now we also say writing an option. This is just the, professional way to say it. So if you see someone saying that they're writing an option, what they're doing is selling someone else the option to do something, right? So they're receiving that premiums. And obviously if you're a buyer, then you're just buying an option, which means you're paying for the right to do something in the future. Now, what we see on this trading screen is a bunch of different prices, right? So the actual price of Bitcoin right now, as you can see in the top left-hand corner, is $20,280. Now, depending on where the option is, it may either be in, at, or out the money. In the money, it depends on what the option is, but for a call option, in the money is when you have the right to buy something below the current price, right? Because you have the option to buy at a cheaper price than it is in the market. So for a call option, anything where you can buy at a cheaper price, that's known as in the money. So if 20,000 is the price right now, and this is the at the money, because you're right at the same price, anything underneath this is in the money for a call option, because people have the option here, if they own that, to buy at a cheaper price. That's good for them, they're making money. Anything this way, down below the, the actual price. These are out the money because these options are worthless, because if you have the option to buy Bitcoin at 23,000 and it's currently 20,000 in the market, that option is worthless because you won't exercise it, right? So in the money is underneath the price for a call and above the price for a put. Remember, a put is the option to sell, right? So if you have the option to sell something, for example, at 22,000 and the current price is 20,000, that's pretty good for you, right? So that's in the money. So it's the opposite for a put, right? So if you have the option to sell at a really high price, that's good for you. You're going to make money. If you have the option to sell down here at like 15,000, that's no good for you. You might as well do it in the market because it's a better price. And so these below are out the money for the right to sell for puts, and above is in the money for puts. So it changes whether you've got a call or a put option, right? The right to buy a call or the right to sell a put. But as you can see here, you can work this out on the screen. So you're either in, which means the options is in profit right now. You're either out, which means it's worthless, or you're at, which is right at the same price. Let's go through a very simple call option example and a put option example to just explain it a little bit further. So with an option, we have all of the specific prices and expiry dates that you can see all throughout this screen. So there's a strike price right here. So as an example, we have Bitcoin with a strike price of 20,000. Okay, so the option gives you the right to buy at 20,000 in the future, maybe in a week's time. The premium for this option is 200, right? So that's what, if you're buying this option, if you want to buy a call, you want to get at least the price up to 20,200, right? Because if you have to spend 20,000 for the Bitcoin with that option, plus paying 200 for a premium for the option itself, then you need at least 20,200 and above for the actual price at the time of expiry to break even, right? You want it above that to make a profit. The market price right now for Bitcoin at the time of trading the option was 19,000, right? So what this is essentially doing is saying, the seller is saying, you can buy Bitcoin off me at 20,000 in the future, and pay me $200 for that option. So the expiry, let's fast forward like a week, the actual price of Bitcoin is 22,000. So as the buyer of an option, you spent $200 for the right to buy Bitcoin at 20,000 in a week's time, and the price was 22,000. So you're definitely in profit here, right? So let's say you are in profit. Well, you will exercise this. You don't have to exercise an option at all if you own it because it's optional, but you will do because you're in a profit from this call option. So you exercise the option, and that means you have to buy the Bitcoin from them, right? So your total cost is 20,000 because that's the option strike price that you buy it from, plus the 200, which is the premium. So your total cost is 20,200, and then the total that you sell the Bitcoin for in the market is 22,000. So your profit is 20,000 minus that, which is 1,800. Now, a big key thing to note is that when you trade crypto options on platforms like Bybit and Binance, you don't have to buy the Bitcoin. When the option expires, it will be cash settled, okay? So the difference between the strike price of the option and whatever it is in the market at the time, whatever that difference is, the cash difference is settled. So you don't need $20,000 to buy one Bitcoin. It will just be a cash settled difference, and so you don't have to deal with all of the delivery of the Bitcoin and everything like that. So everything is cash settled when trading crypto options. This guy obviously makes a profit because the price has gone up to 22,000. What about calls if you're selling them though, right? So if you gave someone else the option, well, you actually need to deliver Bitcoin right now because you're selling it to them, right? So you have to go into the market and you have to buy Bitcoin at 22,000 because that's the current market price. And you get, as you can see, 200, which is the premium that they paid you. And so you have to sell it to them at 20,000, right? So you're selling to them at 20,000, you have to go into the market and buy at 22, so that's a loss, but you're also getting $200 for that premium. So your total loss would be 1,800. You can see that this is a zero-sum game where there's just a winner and a loser in this example. Put options give you the right to buy or sell something, and so we can do the exact same thing with a put example. So same strike price, which is 20,000, same premium, which is 200. You either get that or you have to pay it depending on if you're a buyer or a seller of this. and the market price right now is 21,000, let's say, and the price at expiry is 18,000. So if you have a put, if you paid $200 for the option to sell, would you actually exercise this? Well, you would, and that's because you can sell at 20,000 and the actual price in the market is 18, and so you're in the money, right? So if you're a buyer of a put option, you would do that. So you do exercise, and remember, you can sell Bitcoin now at 20,000 to this guy over here because that's what you bought from him. You bought that option. So you would sell Bitcoin at 20,000. Now you have to go into the market and buy BTC to cover because you're selling it to them, right? But you can buy that at 18,000 in the market, but you need to also pay the premium. So the net there is obviously 1,800 profit. Now the seller of this put, he actually has to buy Bitcoin, right? He has to buy your Bitcoin at a higher price than it currently is in the market. So he has to buy your BTC at 20,000, but obviously he's going to cash settle this. So what he has to do is go and sell it straight away in the market as well at 18,000. So he makes a big loss there, right? He makes a $2,000 loss, but he also receives your premium for $200. So his loss is mitigated a little bit. And again, it's a zero-sum game. Whoever wins, wherever the price is, whoever wins from the strike price to what the actual price is the winner there, and they make the profit and the other guy loses the exact same amount. Why actually trade options then? Well, there's two main reasons. First is to speculate on prices, and it's actually a much cheaper way to do this. You can get leverage with it without even having to take leverage because you're buying an option rather than the actual underlying. And also, you know your risk all the time, which is really good. The second way is to hedge your portfolio. So when you sell options, you receive premiums. So that's like an income. So if you have a portfolio anyway, you can actually receive income and supplement, you know, your portfolio and try to, you know, get an edge out of your portfolio and increase the amount of money that you're earning from it. So I'll go over some of those reasons here. Firstly, let's look at, you know, the call example, the call option, and why you'd go either long or short a call. So you've got long call right here. This is a speculation. You can see it's just a speculation and you're bullish on the price. Now remember, when you buy an option, you pay a premium. So this is the premium that we pay, right? And we pay that all the time. Now, if the strike price is 100, right, to make money out of an option, if you're paying money for it, you need the strike price, you need the price to be above all of your costs, right? So let's say the strike price of an option is 100. You need the price in the market to be 100 plus whatever the premium that you paid is, and that's your break even right here. Okay, so if you paid whatever, $50 for the premium, then your break even is 150. Right? So it's a strike price of 100 plus the premium. That is your profit. Now with a call option, because the price can go up theoretically forever, your potential profit is unlimited and your potential loss is just whatever you paid for the option. That's why people like to speculate long with calls, because they can just put like a small amount in, and you know, if they put $500 in and the option expires worthless, they know exactly how much they're risking, right? Which is 100% of your money. Much riskier than the spot market, right? Because if the price doesn't go up a little bit, then you've lost all your money. So it's much riskier, but it's like taking leverage with a specific amount that you can lose. But with a long call, the price can theoretically go up forever, but it won't, because you've got an expiry date that is within a week or a month, right? Now with a short call, if you're selling someone a call, so on this side right here, you can see all of these traders that are actually selling calls. Remember, we're in the call market, we're on the left-hand side. And so these guys in red, just like every other market where you have a buy and a sell side. So let's try and open this. And what we can see is there's a market for the option, right? So you're either a buyer of the call, so you'll bid for this, or you're a seller of the call. And if you sell calls, like I said, on Bybit, it's all cash settled. But let's put an option in here. So 305, we can bid for that. We'll bid for one option. And as you can see, just get rid of myself, is that your max loss is what you pay for the option. And then the max potential upside is obviously unlimited, because you know, the potential upwards move is unlimited, although it's not going to be unlimited, right? There's going to be a price that it gets to. Now, when you go short a call, which you can do because everything is cash settled here, so you put USDT on account to trade, you can go short here, so you can actually sell these, right? Sell, and then you can see here your profitability. Now, remember, if you're selling an option, the max that you can receive is the max that you can make is the premium, right? Because we have this premium here that is paid to the seller of a call if you go short the call. So you'll receive that premium. If the price essentially doesn't move or goes down, then you will make this, right? So here's the strike price right here, whatever it is, let's say 20,000. If you're giving someone the option to buy at 20,000 and then a week later the price is like 19,000, they're not going to buy it from you at a more expensive price, right? And so the option expires worthless. Because the option expires worthless, you still receive that premium. And so there you go, you've made the premium and you've made your profits. Now, if the price starts to move up, well, your profit is, as you can see, the strike price plus the premium that you got, because you got that from the buyer of the option. And then that is your break even right here. That's your break even, which is the strike price plus the profit, plus the premium. And then anything after that, that's when you start losing money, when the price is moving up, because they have the right to buy at 20,000 and the price in the market is 25, right? And so they're buying at a cheaper price. So why go short a call? Well, essentially you're trying to receive the premium, right? So you have, let's say you have 1 Bitcoin and you're like, I don't think the price is going to go up. You can just sell people calls all the time and receive their premiums. And if it doesn't go up, happy days, you're just receiving that premium. That's known as a covered call. So if you have Bitcoin already to cover your option, it's known as a covered call. You can just have a naked call, or you go short call naked, naked meaning you don't have any underlying to cover. So you're just taking a speculation on the price there. But if you have BTC and you're selling people calls out the money, just receiving premiums, you're basically earning some income on that. And yeah, you have the Bitcoin as well. And so if the price does go up and they actually, make some money off you, well, you've got the Bitcoin as well. And so you've mitigated, potentially a big loss because your Bitcoin's gone up. You have to sell it for them at a cheaper price, but you actually have Bitcoin to cover. So that's like a slightly reduced risk bet because you're kind of willing to sell, right? There's a part of you that wants to sell the BTC anyway if it does go a bit higher. So you're kind of happy to sell if you have some BTC already. But really it is a speculation, just saying, I don't think the price is going to go up, but I want to receive those premiums. Let's look at puts then. You can go long or short a put and the profit and loss here. And again, if you want to know specifically how to use each platform, like on Bybit, I have a specific Bybit options guide, which goes through more details about what all of these different options are right here. So I'll leave links in the description to the crypto options trading guides as well on these platforms, where you can see everything explained as well. But with puts, you can either buy a put or you can sell a put. Let's go long puts first. So we are buying the option to sell in the future. And the only reason you do this is for insurance, right? So let's look at this one right here. Why go long a put? Because you're bearish on the price and you want to protect your downside. This is actually a really great way to protect your downside because what you're doing is basically buying insurance, right? So you're buying the option to sell at a given price. So let's say you have BTC and you think the price is going to go down and you think it's going to go down a lot. What you can do is basically buy the right to sell it at a higher price than you think it's going to. So it's exactly like buying insurance where you're saying, I'm going to pay this premium, right, for the option to sell you at this price right here. Now, if the price goes down a lot, you actually, you save money. You're basically making money on this. Remember, you can just do this to speculate as well. You don't need Bitcoin there. But if you have the right to sell at a given price, right, and it goes lower than this, well, you have to pay the premium. So this is the premium that you pay, which is right here. That's like $50 or whatever, right? And then once you've got the price below a certain level, the strike price plus what you paid, and it keeps going lower, that's when you start making profits, right? Because essentially you've been able to sell at a more expensive price than it is in the market. Now, if the price keeps going up past this, essentially you just lose your premium that you paid because you paid for the option to sell at let's say 20,000, but the price is 22,000 in the market. And so you've just paid this premium for no reason basically, and you can't exercise. And so you've just paid money out. So what you could do here is if you thought the price of Bitcoin was going down, you could actually go onto the put side right here. And let's say we want to buy puts at 20,000, right? Let's say you think next week the price of Bitcoin is going to be 19. We want to buy these puts right here. So we could go buy 1 BTC like this. and we want to buy these. And then you can see that essentially what we're doing is if the price goes way below to like, 18,000, 12,000, we make lots of money on that option, right? Now, if it goes above 20,000, then we've just spent our premium on that option, on that insurance, and it's basically not helped us out, right? So when you go long a put, you're basically buying insurance. Now, when you go short a put, you are essentially, you can speculate here, but you can also be hedging your positions as well. So when you go short a put, you're giving someone the option to sell you something in the future. So you receive the premium. So this is what you receive, and this is the profit. If the price starts going up, as you can see here, you make your premium, but you don't have to sell. And so that's really good. So what you're saying is, hey, come and sell me Bitcoin at 20K, right? And if the price is, and they'll pay you for that option, but if at expiry the price is 22K, they're going to sell it in the market and not sell it to you at 20, and so you just receive that premium. Now you actually lose money if the price does fall because you're taking a bet on the price going up essentially, right? Or neutral at least. And so obviously you start receiving this premium, but after that, the strike price plus the premium, if it goes down further, you start losing money here, right? So if this is 20K and then the price gets to 18K, they're going to sell it to you at 20. And so that's what you're losing, right? So this is a visualization of those examples that I gave you earlier. And you can see it right on here as well. You can either buy or sell a put, buy or sell right here. You can see the P&L on Bybit anyway. You can see that very easily about how much you receive and how much your potential loss is, dependent on whether you're going long or short, either a call or a put. Now, trading options like this is an okay strategy, but you're essentially speculating all the time. Even if you have crypto in your portfolio already, you are speculating on the price. Well, you can do that in a cheaper way by using something known as spreads, call spreads and put spreads. I'll explain what a call spread is right now. A call spread is a more professional way to perform a bullish call on the price of something. So we went through what a long call is, which is where you pay a premium, which is this, and then you make money if the price rises from the strike price plus the premium that you paid, and it goes up, you start making money, right? So you're bullish when you buy calls. But the price never goes up to infinity, especially if you're trading for like a week or something, right? And so what professionals can do is what's known as a spread, where they buy a call option, but they also sell a call option higher in order to receive premiums. This has the effect of limiting their potential upside, but also reducing the cost of the option that they bought, the call option that they bought. So here's how that works, right? Let's say the original option that you bought plus the premium, right, was at a level where the break even is 45, right? So the chart would look like this. You'd have the chart right here, it'd start creeping up, and at 45 would be your break even, and that could go up to infinity, right? But within a week, the price cannot go up to infinity. And so what you can do is sell the exact same amount of the call option as well. So what has that has the effect of limiting your potential upside, but that's fine, because what you do is you're also getting money back on the premium that you paid for the call option. So you're reducing your cost and moving your break even down. Now you're giving up some potential upside, but a professional would look at the price and say, well, the implied volatility here is such that it's never going to go up more above like 22K for Bitcoin. And so that's fine. We can limit that upside because the probability of it going to there is so low, and reduce the cost of our premium because we're paying the premium, but we're also receiving a premium. Let me show you how that works on a trading platform. We can buy calls on the 5th of November, which I think is tomorrow as of making this video. So what we can do right here is say we're going to buy the 20,500 calls. Price right now in the market is 20,261. So 2050s are going to be expensive. We're going to buy these calls. So we go over here, buy, then you can do any amount that you want. And then you'd have to buy these calls. Now you can see the premium that you're going to pay is around 100, right? So if you actually bid 95, you might get hit here. If you want to take the offer, you'll have to pay 110, or you can bid 100 and see if the order goes through, right? So you've now paid $95 for the call option. So that's your payout, right? Your $95 is what you're on the hook for. That's the premium that you paid. So you need the price to move at least that to break even. But what we can also do is go and sell a call option at a higher price that we don't think it will get to. So we can come over here to the left and say, we can sell this option, the call option, at 21,000. So we can go here, we can go sell the exact same amount of BTC, right? Because we want the positions to net off. So that would be one option here. And we can go and sell that to someone and we get 20. So what we've done is we've paid 95 for the call option going long, but we've also received, because we're going short here, we need to sell this, we've received, let's say around $20. So instead of paying $95 for our option, we're now paying $75 for our option. What we've done is we've reduced the max loss, right? We've reduced the break even. And yes, we have reduced our potential profit, but within a day, it's not going to jump 20% or whatever it is, right? And so that is what a call spread is. It's where you're bullish, but you are selling another call above to receive some premiums and reduce your costs. You can also use a put spread though, which is when you think the price is going to moderately decline. And so you want to buy the option to sell at a high price. But obviously the price isn't going to go to zero, at least not in a week or so. And so what we can do is also sell an option, a put option below, in order to reduce the premiums that we pay. So here's how that works. If you were to do a put spread, what you're doing is potentially trying to take advantage of the price just moving lower, and you're selling at a higher price. But when you buy a put option, you have to pay quite a high premium, right? So instead of paying a high premium, so for example, if you say we're going to sell BTC and the price is currently 20,221. So what we want to do is sell BTC at, let's say, 20,250 right here, because we think the price is going to go lower. And so we want to buy the put in order to sell at 2250. Next week, maybe the price has dropped to like, 19,500 or something like that, right? So we can buy that put, but look how expensive it is, right? You have to pay $210 for this put. So you could go right here, you could buy your put, could pay $210, but you've got $210 as a premium now, right? So you can see that you have to pay quite a lot. And if the price does fall, then you start making money, but it's never going to get to like 15,000. So what we would do is try and reduce the cost of that premium by actually selling a put. And then what you're doing is just taking the spread here, right? So you're taking a profit out of the spread. So what this would be is price at expiration, you're buying a put and selling it at a level. And really, this is the cost for you, right? That's the premium that you pay. And so wherever the long put strike price is, which is right here, you have to pay your premium on top before you start making a profit. And so what we're trying to do is reduce the cost of the put. So we are buying a put to sell at a high price, like 20,250, we're paying 205. But what we want to do is also sell a put down here at 19,500, because we think the price is going to moderately fall to 19,750. And so we can say, we can top our profit out at 19,500, right? So what we're looking to do is for that price to go right down to like 19,500 and one, because we don't want them to exercise, right? So that would be the cap of our profit, selling at 2250, and this 25 or this 30, right? So we click on this one. Remember, we have to go short the put here, so the exact same amount. So we're giving someone the right to sell to us at this price at 19,500. So we're capping our profit. The most profit we can make is selling to the other person here at 2250 minus the premium that we paid. Okay, so you have to take that into account. You can see it's quite a lot here. So we're trying to reduce this cost by saying at this price, we can also buy Bitcoin right at this price as well, at 19,500 plus 25. So what you're doing is capping your profit, right? The best profit is to buy the option here at 20,250 and pay the premium to 205, and hopefully it goes to like 17,000, right? That would be a great profit, but it probably won't do that. And so by just selling a put right here, you're capping your profit, because if it goes lower, you have to sell at this price. But you can see by receiving the premiums here, by selling this one at the exact same amount, you're receiving that premium, and so you're reducing your cost of this one. So what you're looking for with a put spread is for the price to moderately decline down and get the cheapest premiums that you can, making it cheaper by selling that put there. So as you can see, we're making our cost cheaper, and so our price and cost of the option is a little bit less, right? So we don't have to fall as far because we've taken a little bit of premiums back, but if it does fall, we've capped the price. So what are spreads? They're just a way for you to take a bullish or bearish stance and just make your options premiums as small as possible whilst capping your potential profits. But usually a good thing, because a price can only move so much in a given amount of time. Spreads only work in moderately volatile markets. And so if you have very highly volatile markets, you'll be missing out on tons of profit. But options spreads work best when you think the price is going to be moderately going in one way or the other. And so it reduces the costs of each strategy, but it limits the potential profits to basically the difference in the strike prices, right? So you're taking that spread between top and bottom and either bullish or bearish bias, dependent on whether you're going on a bull spread or a put spread. These option strategies then can actually help us gain some income from our portfolio and trade around the edges and hedge out some price differences only in quite compact markets. So if there's a lot of volatility, then the spreads aren't very good. Now, if you're using Binance or Bybit, they actually have beginner platforms called dual asset. And this is options strategies. I've actually got video guides on how to trade dual asset platforms, both on Bybit and Binance. I'll link them in the description. They use options trading strategies to try and earn a yield out of the market. They are best, as you can see, in low volatility markets. So if you have a ranging market, then you can use options strategies to try and earn some passive income from that. But there are, of course, some risks dependent on if the volatility exceeds what the strategy is doing. I explain all of that in those videos, so I'll leave that below. If you want to get really professional with options trading and futures trading as well, the crypto course has entire sections on day trading, futures trading, and options trading. You can see them all here, updated regularly as well. So check that link in the description. It goes through all of these option strategies way more in depth and how to implement them as well. So that might help you out. Links all down below. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.